So like I mentioned, we're going to go through, it says how to analyze a multifamily deal. It's a little bit more than that. It's more of a case study, kind of showing you the whole, all the different steps between what it takes to acquire one of these multifamily deals. Um, so we've got some examples throughout and we'll dive a little deeper. And if you guys have questions on, like I mentioned, any part of it, just go ahead and ask at any time. I'll start off by telling you a little bit about us. We're Elevate Commercial Investment Group. We are a real estate firm. We acquire multifamily assets, value add assets, anywhere from C class to A class apartments, usually 100 plus units. We've acquired over 7,000 units in the last about 7 years. We've exited a little bit over 1,800 of those. In those exits, we've averaged to our investors a 47.7% IRR. And currently, we've got right around 650 million in assets under management. There's a ton of experience within the group. As you can see, some of the faces there on the screen. We've built a really strong, solid team to acquire these deals. You've got myself, the CEO, partner Eric, who runs our day to day. He's the COO. Got Brian, who's on here now. He's our chief investment officer. Nick, who's also with us. He's our senior analyst. Also, does most of our acquisition or heads up the acquisitions. Then you've got Joel, who runs our asset management. Mina, who's usually on here. He couldn't be on here today, but he runs our investor relations. And then we're vertically integrated. We also got a management company, which you see Tessa and Mike on there. They run the management company. And then we also have a construction company. So we're able to really be able to step in and implement our business plan on these deals. So, like I was saying, vertically integrated, you've got Elevate and then Elevate Real Estate Management and J&T Construction. They all work hand in hand. To what we learned early on, going back a little bit, myself and Eric, we've actually been in real estate for over 17 years, started in the single family space and then worked our way up to larger multifamily. Um, and what we learned early on was to be able to scale, you really have to be able to control these aspects, the management and the
Be able to
construction.
control these aspects.
That was me. My fault.
Okay, that was weird. I was like, whoa.
You have been known to have some but that was 100% me. Yeah.
Okay. Um, yeah, so I think that's where the being vertically integration comes into play and why we've been able to be successful in this.
Um, AP's saying he doesn't get any see any video. Does anyone else have any issues with video? I see it on the Facebook group. Looks like it's no video. Interesting.
No video, like they can't see what I'm sharing.
Mm-hmm. It's a slideshow, right? Yes, that is right. Oh, Tiffany says I can see fine.
Oh,
Everyone else is saying no. Oh, I can see the slide. We can see now.
okay. Well, let me reshare it then.
Here, let me try mine. Share screen. How do you okay,
Slideshow. Yeah. Okay.
someone has I can see video now, we can see now. I had to leave and join again. Perfect. Coming through fine.
Nice.
And good looking out, guys. Appreciate you.
Yeah, so now that diving a little deeper, right? You know, that gives you an idea of who we are and our experience level. So what we're gonna go over today is, like I mentioned, what it takes to get one of these deals closed from beginning to end. Um, what do the numbers look like? Um, the underwriting and which metrics we really like to focus on and all that kind of stuff. All the way to going on site from the first time of touring the property, what exactly we're looking for, to then the next level where we start putting the capex together and putting the budget together for the renovations. Some of the things to look out for during due diligence. Some of the processes of reviewing all of this throughout the transaction. You know, there's several times where we revisit our underwriting and we need to, depending on what we find on these on-site inspections or what we find when we get certain documents, we need to continue to adjust the underwriting and make sure that at all times we haven't seen a huge red flag that um, tells us that we need to walk away from a deal, right? Um, and a lot more that comes with that. So oh, you're controlling it now. So yeah, what you want to go to the next one? Okay. Do you want to take over from here?
Yeah, so we're on step one for my criteria.
Yeah.
Gotcha. So I mean, yeah, I'd say this is a pretty important place to start. Before you buy, you got to know what you're looking for, and that really is going to come down to market, asset class, how large of a deal you want to chase. Um, Vintage. Do you want to go after newer stuff or older stuff? And So I mean, talking about market, I'm based in Dallas. We've got a lot of properties in Dallas. We know our market in DFW really well. There's different pockets that we like to make offers on deals. Um, a lot of the stuff in like your Frisco and Plano submarkets is pretty highly priced right now. That's typically not the type of deal that we're going to chase just because the return profile isn't really what we're looking for. Although there's some types of deals that might work there. We're typically going after more of the stuff in like the suburban DFW, outer banks type micro submarkets that still have really good population growth and demographics. So really important is, just studying your market, knowing, what jobs are driving the macro and micro parts of each market, what the neighborhoods are like, what the crime is like, and really what type of person lives there is really the important thing to understand. And then asset class, do you want to go after A, B, or C? C class stuff is typically higher risk, higher reward. That is going to involve more operational challenges, as your tenant base is typically lower income, so that you're going to have higher turnover, more chasing down tenants for payments, stuff like that, but not all the time. But that typically comes with a higher, projected return as you're hopefully adding a lot of value through renovations and capital improvement projects. B and A class stuff is typically what we're looking for right now. As the risk reward profile feels a lot better right now than C class stuff. Although we're still offering on C class, so not to say that every deal's got a good story to it. Unit count, that's pretty important to know going in, because that determines how much capital, debt, and equity you're going to need for a deal. Each market's very different. We're again based in Dallas. A class deals are Those are going anywhere from, you know, 230 to 260 a door. We just saw Blackstone sold to Equity Residential today, and that portfolio included 11 properties, and some of those were based in Dallas. And that sale price was around 269 a door across 3,000 or so apartments. So A-class stuff is typically going to have a higher unit count, higher price per unit. So, you know, it really just depends on your direction as an investor and your risk appetite and reward appetite. And that also plays into vintage. You know, the newer vintage stuff is going to be it's going to be lighter capital intensive with lower capex plans typically, and generally what comes with that is a lower return profile, but not all the time. So I think that pretty much covers this slide here. So yeah, step 2, property info. So, you know, how are you going to locate the deal? You gotta go through multiple channels here. You know, you got brokers, you got driving for dollars, actually getting around and calling on property owners, looking up tax statements and owner history and the tax records, and just calling owners directly, cold calling them, emailing them, etc. There's a million ways to find deals in this market. And, you know, typically we're leveraging our broker network. We're doing all of this right now. We're cold calling. We are talking to owners that you know, maybe one deal didn't work with them, and so we're asking if you got anything else to sell. We'll take a look at that. So really, it's just, you know, having your hands in many different buckets and trying to get as much deal volume as possible, because the name of the game is looking at a lot of deals so you can get better at understanding what makes a good deal and what makes a bad deal. What's the story? You know, I think this is pretty important. Always try to figure out what the story is on the deal and why they're interested in selling. That could be really anything. It could be the owner's retiring, they're moving, you know, to Bahamas, or it could be that, you know, their debt's coming due and it's maturing and they don't want to refinance, or they can't refinance because their you know, their new debt sizing doesn't work out and they don't want to come in with new cash to refinance. So there's a number of different reasons why they are selling. The important thing to know is just why they're selling. We don't like to waste a lot of time on deals where there really isn't a strong reason that they're selling, because then you kind of get into this weird area of maybe chasing a deal and paying too much for it, and because the owner isn't actually a real seller, and they're just fishing for a price that they really want to get the highest and best price for. So really important to know why the owner's selling in the first place, and understanding what has been done to the property by the current owner and past owners as far as capital improvements, plumbing, roofs, exteriors, parking, any unit upgrades, and really just understanding the history of the property is important. And yeah, let's see, I guess, yeah, getting a price as well. Pricing expectation up front is really important. Because one, the more you look at deals, the more you'll understand, all right, you know, what are the asking rents in the market? What price do they want? And then immediately you'll be able to tell if there's a deal worth chasing or not, just based on those two items. If their price is somewhat realistic, then you obviously dig in a lot more. But, you know, those are really the two things that I need: vintage, price, and what are the asking rents of the property today, and maybe a comp or two to see how much potential we could push rents as well. I think that's
Yeah, I
good.
think the big point there too, you know, touching on that story, it's kind of about efficiency of time. You don't want to be chasing down a deal that there isn't really a story there, and that also goes back to efficiency of time here. I think you want to start more narrow and then kind of broaden from there. So maybe you're choosing a specific market, and then you're looking at all the asset classes within that market. Or maybe you're choosing C class assets only, but you're looking at all we have some investors that are looking at only A class and only kind of submarkets. And same thing here. If they're chasing this deal that there's no reason, likely the broker just said, hey, let me kind of get you offer. I can go fish for offers for you pretty much. If there's no story, they may not really be wanting to sell it anyways. And then you end up wasting quite a bit of your time. But you kind of figure that out as you start. The best way to do that is start making offers and talking to brokers and talking to owners too. So these are all good points here. Locating the deal brokers, great here. Driving for dollars, finding, this kind of works a lot with C-class deals, but you can do it for A-class development deals too. We find a lot of developers incentivized right now, cold calling off lists of your criteria that you look for, right? In this slide, you're creating the criteria, and here you're going out with a criteria. Because if you're just saying, hey, I'm looking for multifamily deals, then someone might not take you seriously, owner, and you're not really telling them what you want. So I think having somewhat of a good idea there. And then we also get other people that are bringing us deals too. Someone might be local to Raleigh, North Carolina, and they have the in with someone there, an off marketed deal. Something we didn't really touch about here. Off market, there is a lot of money in the off market, and the off market is a loose term, whether that's broadly marketed, maybe sent to an email list. But that's another way too. You're talking to other people in different markets. If you're in New York, but you don't invest in New York, or you're in Maui, but you're not investing in Maui. So yeah, that was good. So yeah, further on, I'm gonna pass this back to Nick here on the underwriting, because this is a really key point of the deal. After you're getting, so go back, we've got the deal criteria, we're looking at the asset classes, unit counts. We found a deal, maybe we cold called an owner and he said, yeah, I'm willing to sell. I'm actually looking to retire. Or actually, I'm looking to invest in another market. Or yes, I have a partner in here that I want to get out of. So then, okay, for us to start looking, we need to dig into the financials. And that starts with requesting a rent roll and requesting a T12, or a trailing 12-month average of how the property has performed, or in businesses known as your profit and loss. And this is what it'll look like. Sometimes a lot of deals, this is actually not what it'll look like. This is what Nick will put it in, what it'll spit out after we take a look at, depending on the deal. You're looking at more institutional type or larger deals. Hopefully they have clean books. That makes your job underwriting a lot easier. But I've seen as low quality as QuickBooks snapshots, as detailed as some of our underwriting. And sometimes you'll get what's called as a broker pro forma. That's not the actual underwriting, that's what the broker thinks it's going to perform. So usually, no offense if we have some brokers on here, sometimes we have to poke holes in those. A good broker is going to underwrite it pretty conservatively, but it's their job to get aggressive with the underwriting and sell get the most price. So we're looking at that trailing 12-month average and rent roll at the very least. If it's a lease up deal, you can see what their target rents are and what their costs are. But this is a good start right here. I don't know if you would add anything else here before the pre-property, next step would be kind of pre-property tour questionnaire. But anything else on the?
Yeah, I would just add here briefly. I mean, this is really important for us because, you know, we're putting these properties, we're looking at these properties in several different ways. And here we're looking at the numbers and just saying, all right, here's how the property's performed in the past under this ownership. Here's what they've done to the property. Where can we improve operations, whether it's on the income side or the expense side? And, you know, there's a lot that goes into, you know, rental projections and justifying rent bumps and other income items and expenses, ultimately to get down to your net operating income or EBITDA and non-real estate professions and businesses. So ultimately, we're trying to figure out what's going to be our NOI on this property. And we'll run a lot of different scenarios because ultimately this is a projection, and you know, projections can be wrong a lot of the time. So we're trying to put together a scenario as our base case and say, all right, we feel pretty good about, you know, getting these rent bumps because they've achieved these rent bumps across units already at the property. So, you know, that story checks out there. And, you know, we're operating 3 different properties in this submarket, and we think we can operate, you know, payroll at this number and contract at this number. So there's certain levers that you can pull to adjust your net operating income and ultimately your property value over time. So this is really just a way for us to, you know, digest how the property has been operating and what we're going to take it to.
Is this so on this specific example, it doesn't really, it looks like the years got cut off. I'm guessing
Yeah, the years got cut off here. I mean, it would probably be the
year one right here. Oh,
the furthest left column would be probably a broker's projection. Then the second to left would be the trailing 12, and then the one next to it would be the trailing 1 with T12 expenses, and then trailing 1 with pro forma expenses, and then ultimately our pro forma. So there's multiple ways to look at this stuff. But yeah, that column that you're on right now would be our year 1 projection versus how it's performing today. And, you know, in this case, it looks like we're actually projecting a net operating income decrease of 10%. And, you know, we're saying our expenses are going to go up, our insurance and our taxes are going to go up. We need to account for that. So our NOI is going to drop. Instead of it being a 6.9 cap on actual trailing 12 numbers, it's really a 6.2 cap, even after, you know, some rent bumps and stuff here. So
I think that's really important and something I don't know that I actually personally factored in and before like starting working with you more closely is this year one. You know, a lot of times you'll see year ones make these big jumps, you know, but actually, you know, what we're accounting for is a drop. And I guess that's, you know, this drop right here. And you talked about 10% NOI, and I guess about a 1.5% change in revenue. We're just accounting for higher vacancy after we take over.
yeah, it looks like on this one, this was more of a conservative year 1 where we were bumping rents and baking in some more vacancy on turnovers. And then we'd get those incremental rent bumps year 2 with that 4% net rental income increase. You know, this I would call this one probably a very conservative underwriting. Typically, on a stabilized deal, you're going to see some income growth unless you're not operating it properly. So, you know, this would be kind of our, I guess, downside case, and where we would be very comfortable offering at this price.
Yeah, possibly maybe a C-class deal with higher vacancy coming on when you take over. Definitely see that after takeover of C-class, especially. And then yeah, the expenses, I guess the big expenses, we have taxes going up. That's how are you calculating tax growth?
Yeah, taxes different for every single deal, different on a county basis. For this one, I couldn't tell you. I'm not sure exactly what deal this is, but typically we're going to look at the taxable value today, and historically what the county is typically doing on reassessments if they're an aggressive county and they're gonna reassess it at full purchase price, or if they're going to use the income approach and look at comparable properties. There's many ways that the assessor is going to account for tax reassessments. Some counties, they don't even reassess it upon sale. Sometimes it's multiple years until they actually reassess it.
I was about
But
to say, sometimes I see that jump in year 3, and I guess that's when you see a larger jump in like year 3 or 5, that's because that specific county has a certain assessment period.
yeah, exactly. In Texas, it's typically every year. In North Carolina, I think we've looked at a few deals there. It's over a different time period, but yeah, I mean, the taxes are one of the biggest parts of the underwriting, and typically don't like to get very aggressive on our tax assumptions because it's not really something that you can control at the end of the day.
Yeah, and so this is quick underwriting too. I think, when we're doing, like I keep using Raleigh, for example, but like just a market that we don't own, or if it's Louisville, Kentucky, for example, or Lexington, Kentucky, we don't own there, but it's a market that we're interested in. How do we just increase taxes, a different rule of thumb, and then once we get it under contract, then we're asking the county, the local assessor, or how do we go from there?
Yeah, if it's in a market that we haven't purchased in before, I'm probably gonna look up comparable properties on their tax rolls and what the tax per unit is and the tax per square footage is, and use that as a baseline. And then obviously, we'd have our consultant look into what happens post sale. There's multiple ways that we're gonna figure out what the taxes are gonna look like. These are never going to be 100% accurate. They typically give us a range on where these taxes are going to land, and we generally choose the more conservative assumption.
Yeah, that's good.
Every deal is different on taxes.
Yeah, that's really good info. Same thing with insurance, asking someone there.
Yeah.
So, underwriting, we liked our initial underwriting, so we're close at their expectation. Again, we have their story, what their price is, underwriting, that looks good, that checks out. We probably want to look at getting on site on the property. Someone actually mentioned in the chat before we dive in here, do you concentrate on purchasing in your local area so that you can do your own property management and construction management?
We used to. In the beginning, we at first we were looking just in our backyard. So just in Dallas is where I'm at. And ton of competition in this market, so it was hard to find deals that made sense. And then we started doing sort of like a 3-hour radius around Dallas, just because our mindset at that point was if we've got to jump in the car and head over to the property, at least we can get there within 3 hours. That opened us up to more deals, and we were able to acquire more deals doing that. And at this point, we've got the systems and the scale where we can pretty much pick up and do the property management and the construction management anywhere in the US. So, and you'll see that when you look at our portfolio. I mean, we're pretty, I don't want to say spread out, but we definitely have the most properties in Texas, but then we're open to other markets. I mean, we've got some stuff in the Midwest, and we've got stuff in Florida and the Carolinas. So, I mean, yeah, not necessarily.
It's a good place to start, Jose, I would say, and then expand from there. Start same thing, theory from the beginning, starting narrow and going broad. And that's what we did. Yeah, I did that specifically in Northwest Arkansas, Elevate, and Dallas. It's a good place to start, and then you can get an idea of where numbers are at. And now, because of our experience, we're able to pick up and go into any market, except California or Northeast, but
Any market we want to go into.
pretty much. So right here on the pre-property tour questionnaire, I'll go quickly through this, but basically this is getting closer to property site. So we're asking what's the mix of classic units and upgraded units. This is especially true in, you know, C class and B class. A class, usually they're mostly already upgraded, so you're not going to have this disparity, you know, depending on the deal. But this will show us a good idea of what the achievable rent on the property is. It's really great when you can self-comp your own property if you have classic units being rented out for $200 less than upgraded units. Then we're looking at how much it costs to upgrade that unit and what's going to be our return on cost for that rent premium. CapEx, everything that's been completed, you know, here we're going back more than that T12 numbers, you know. Also, when we're looking at the financials, we'll probably go a little further than T12 to see the full picture. You know, they could have a huge expense in year 2 that could really change things. But CapEx, history of CapEx items on property, looking at roof, and other items here. Let's see, this says,
Yeah, so that's essentially what before you go on the property tour, those are the things you're asking the broker, the seller for, to kind of prep yourself for the property tour. And then when you get on site, these are some of the things you want to look at when you're there. Pretty much confirming a lot of what you already asked for. You know, checking that you want to physically see the units. You want to see, you know, if you can peek at the roofs and take a look at it, great. You know, any other CapEx, you know, kind of look at the AC units, see what kind of condition they're in, how old they are. Um, the more you can look at, the better. And this is just helping with your underwriting so that you can tweak those numbers. And I don't know, I don't think we're gonna go through every single line item there.
yeah,
Uh,
and I think the
Third
big ticket
public
items are
today.
especially important.
It's gonna be our last stop. It's starting
Here's
to get
George
dark.
doing
Looking at is
due diligence on a property right here in Oklahoma.
Submit an
Right there,
LOI
I can see flat roofs. How do we feel about flat roofs? We gotta,
around. You tell the couple things, like they've got a not so good, you got a
looks like C-class area, which is
Yeah, that's
fine
the
with their business plan.
best
Alright.
location in Lawton, Oklahoma, man.
And George and I will actually be doing this
Fair enough.
on a deal in
some repairs.
outside of Dallas, Fort Worth
Looked
tomorrow.
around.
So we're
The
starting
lights are working.
exactly this physical due diligence on a new deal. So excited about that one. So once we're on the property, I guess George, if you can give an idea of what
Yeah,
you're,
yeah. So I mean, just more items, right? And you want to take a bunch of pictures while you're on there, and just that way you can even reference back when you get back to the office. Um, and you take all that information, and then you can build out your renovation budget, your CapEx budget. You know, you want to ask a lot of questions to usually the property manager or the leasing agent is going to meet you on site. You want to ask them a lot of things about um, the asking rents, the other income, the demographics. You know, this is when you can really get some insight. Usually they'll have someone on the maintenance team take you to the units. It's a great time to start asking the maintenance team too. Um, what do they usually see? You know, what are the biggest issues? Do they have plumbing, sewer lines backing up? Do they have issues with the chiller, with the boilers, all that kind of stuff? You'll be surprised how much they tell you. Um, so definitely don't feel bad asking. Um, and then sometimes the brokers or the sellers will meet you there to kind of stop you from asking some of that stuff. But
yeah,
go
and
ahead.
this is, and also I missed, but tomorrow we're doing due diligence. So this is pre-DD. This is, you know, post underwriting, and this is to get a better picture of this, your renovation, to dial in on your renovation budget, make sure, before we're looking at sight unseen offer, then we're getting on sites, doing what George is talking about. DD, that's gonna come in a little bit.
Right.
So. Let's see, yeah. This
Yeah,
is.
so with all that information you gather, right, you can come back and then create, maybe still a high level budget, but it's definitely more detailed. The more information you're able to get, the more detail you can put into this renovation budget. This one's obviously with our construction arm, and this one's pretty detailed. But once again, I mean, the more detailed, the more you can sharpen the pencil on your numbers and feel comfortable with them, then the better the offer you can make. So I highly suggest that you try to get as detailed as you can.
Yeah, so here it looks like 954,000. After we walk the property, we're looking at 954,000. So if we go back and look at for here, I don't know if it shows. Okay.
That's not gonna have your CapEx there.
Yeah, usually in your sources and uses, so not quite here on your operating, so that'd be prior to this. So comparing that to your original budget, right here, we're finalizing the underwriting.
Yeah, total CapEx budget. You can see down there. I mean, this isn't the same deal, so it's not 900, but I think it says 400,000 something total CapEx budget. Yeah, so then once you have all that information, right? Let's say you gathered more information about the leasing or the other income or expenses or whatever, and then you've got a better number for your renovations. You plug that all in, and now you should base your offer on what you have here. And let me see, we got a detailed full pro forma. Yeah, so this would be the time, to put together a detailed pro forma. You can check on the returns, see if the returns are meeting your criteria for yourself and your investors, and you can do several stress tests, see what type of risk you're going to run into as far as occupancy or debt service, IRR, all different types of stress tests. You can, we usually on this phase, we would be getting more, what am I trying to say here? So the vendors, the insurance, I mean, the taxes and a vendor, but we use a consultant to get a better number on property taxes, insurance, debt. Like you want to get better numbers for all those and put them into the underwriting. So then you feel more confident with the offer you're making.
Someone asked, sorry for the delay on my question. What's an underwriting contingency strategy for vacancy issues after year one?
An underwriting contingency okay. Yeah, I mean, I guess I'd probably look at I'll go back to the historical financials and look at how has the property performed over the last 12 months. Has there been a spike in vacancy in any of those months? And let's say it's a 20% vacancy spike one month. I would adjust, I would run the numbers to make sure, we're breaking even. Our debt service is breaking even if we do hit that vacancy again. I mean, really, I would also get our property manager involved and get an understanding of the comps and really what's the market occupancy for the market, and understanding if there's new supply coming in, near our property that we're looking to buy, because that could potentially affect their occupancy there. But you know, you don't want to really have unnecessary contingencies unless some of those risks are there. You know, we like to have logic behind all of our assumptions, and if a market is really well occupied, there's no supply coming in the future, and it's been operating at 95% for the past 3 years, then, you know, there's a really good chance that it's going to continue on that path. Although we're not gonna, you know, overfund the deal with a contingency just in case that we, you know, drop significantly on occupancy there. So I hope that answers your question. I kind of worked around there, but
Yeah, I think that's good. You know, you can't just say, yeah, a 3% for A class, strong market, or 10% for C class. You know, I've seen those. You know, it depends. After year one, anywhere from 3 to 10% to 0%. You know, you'll have bad debt in there, but really looking at, like Nick said, how the property has performed the past 12 months and checking those vacancy numbers, and also concessions. And then also looking at the market vacancy. You know, Dallas has pretty relatively low market vacancy. Northwest Arkansas has like no vacancy. You know, comparing that to or South Dakota, vacancy is very low there too. So it depends on the market too. Do you physically go yourself initially to the site inspection during the due diligence and then hire someone to do an official inspection?
Yeah, so during the property tour, right? So we don't have it under contract yet. Yes, that would be one of us going out there, um, coming up with those high level numbers on what is needed. Now, once we go under contract and we're in due diligence, at that point, we do want to hire somebody to walk every single unit, and we're going to go through that in a little more detail. So yeah, at first it's us. Then once we're under contract, we would hire somebody. I think there was one more here. So do you all concentrate on properties that are over a certain unit count, 100 units, 200 units? You know, I would say that we like to do at least 100 units. That gets us 2 staff members, you know, one for maintenance, one for the office on site. So we really like to have that on-site staff. Anything smaller than that gets a little more difficult. And you got to have more floating staff from property to property. And then really the sweet spot somewhere like in the 200 to 300 unit range is you're able to support a really strong staff on site is really what it's about.
Yeah, typically 100 units and up, and depends on the market. I guess, you know, we get deals sent pretty wide range, but if you're sending a deal, that is a good one to have. Yes, thank you. Okay, so finalize the underwriting. Submitting a confident LOI and then going to contract. So here we've done our initial underwriting. We've toured the property, went back to our underwriting, tweaked it, finalized it, and we're making an offer with the intent to make an earnest money deposit, you know, hundreds of thousands of dollars usually. You know, purchase price here, you'd probably see, you know, I guess it's usually around 1%, so 20,000. Usually our deals are closer to you know, hundreds of thousands for earnest money, and that's going to change whether that's refundable after DD. Some people get very aggressive and do non-refundable DD. We like to do refundable.
Man, look at that date, December 19th, 2018. This was a pretty old presentation that we revived.
Nice. Been getting after it for a few years here now. So yeah, this is gonna have the terms, you know, once this is agreed upon, then you go to PSA. So this is actually something we just are in the process of right now. We have an LOI accepted, and now we have PSAs going. So that this is the general agreement between all parties, and with the expectation to execute the PSA, purchase sale agreement. Now, once we've agreed on that price, conditions, usually we're putting in closing time. We're gonna close in 60 days with a 30-day extension, 30 days due diligence, another 30 days to finance the deal, and then another 30 days for contingencies. So usually you're seeing closings anywhere from 60 to 90 days. Sometimes those drag on 120 days plus, depending on the situation, motivation there. We've got that accepted. We're getting PSA signed, which is PSA is pretty much just a formal version of this LOI that is attorney approved, I would say. That you can't back out of, and there would be financial remuneration if you did. So due diligence. So what was the 7 steps? Do these deals usually take about a month or 3? It depends. I mean, it could take 6 months, 12 months, 1 month, 3 months. I mean, the deal we're now going under due diligence. I mean, we've been looking at it. Been talking to them since maybe February. When was the first time we talked to the guys and that are Berlin?
Yeah, probably February.
February, yeah. 6 months. So that's also why it's good not to be just only chasing one, we didn't talk about that too, but if this was the only deal that we were counting on and for some reason something happened, then, we would not be, we'd be out of luck. We'd spent all this time. So it's good to have multiple irons in the fire, with the expectation. And that's when when you have those irons in the fire, you're kind of right around this time, LOI period is when you're figuring out, okay, I'm going to move forward with this. But yeah, so 3 months is after it goes under contract. To get it from the first step to now, we could even look at the first step, defining your deal criteria. Some people don't even do that, and they're just going after single family here, mobile home park here, multifamily here, or I'm going after all multifamily, and then some might get a good deal right away. It might take 100 calls to brokers. You might go through 100 deals and you get one deal. So a lot of variables there. Due diligence, we got a couple minutes. So I'm going to go through these last one real quick and then open it up for a couple questions. Due diligence. This is what we're actually starting tomorrow and Friday. Nick had already done the property tour. Now our LOI has been accepted. Our PSA is just about accepted. We're actually going a little early. PSA first look, nothing big change, just some minor legal there. So getting ahead of the game, doing due diligence. We'll walk every single unit, talking to the leasing again, getting professional to scope the sewer lines. This is not just on C-class deals. We just did this on all our A-class deals, checking out these big ticket items again.
Yep, they're scheduled for tomorrow. They'll be doing the sewer lines.
Sewer, and yeah, so that's important, especially with the new builds. They can have issues there. Hopefully no issues here, but this is things that we're doing in due diligence that could have major changes to our agreed upon price. Again, we're going back to our budget again after the deep dive due diligence. We're revising our budget based on any findings there. And sometimes in this due diligence, our CapEx scope might change. Maybe we found that the residents would rather have a volleyball court than a pickleball court, or maybe we decide there's a good spot on the property for more carports, or we hear a resident or talk to a leasing agent there.
Brian, play that video. It's really short and just gives everybody an idea of how many folks are out there at any given time doing the due diligence.
Yeah, you guys have an app that I'm pretty sure that connects everyone takes pictures of the unit. You can
Yep.
upload all the pictures and put notes into every single unit there too. So yeah, DD, there's definitely a little mini army out there. Depending on how many units. Revising this budget. Pre-construction and then close. Someone asked if we have a copy of our DD template. Shoot us an email, info@elevatecig.com, and I'll see if we can get you something there, Steve. So we're closing after this. Yeah, we're revising our budget here, and then getting set up for close. So we're gonna start, during this process, we start raising we're sending it to our investors. We're sending it, right about DD is when we start sending it out to our investors. Hey, here's our new opportunity for a deal. And we start giving them the details, high level summary. We're finalizing our syndication documents, getting our legal documents ready for our investors, getting bank accounts set up, getting whatever property management team we have in place ready for takeover. They're talking to the current property management. We get those guys going. We're getting legal, reviewing everything, not just the syndication documents, but the title work. We're getting title involved. We're getting insurance ready to take, getting our insurance ready to execute. Then any kind of CapEx, any big CapEx, we'd like to get that started day one. So we're really going to be doing that for this next deal, getting them queued up, getting them scheduled to start, those projects right away. So, Will, I'm trying to be part of the DD Army. Nice. Hit us up. See if J&T were able to do that mostly in-house, but we always open up property tours with our investors and with our partners. So happy to have you along there.
Hey, somebody asked about the due diligence inspection. They're saying, so is it a property management company or a third party vendor that does the inspection? Is there a charge? How much? So when we first started, we did use the property manager to do this, and we noticed that they weren't very detailed. They didn't get us all the information we wanted. A lot of them will do it at no charge if they know they're going to be the property manager, but you get what you pay for, right? And if you're not paying for anything, you're not getting much. So now we do hire third parties, and due diligence, usually you're paying somewhere between $30 to $40 per unit or so. And then we can also do as far as the lease audit and some market study stuff. We usually hire a third party for that as well, and I forget how much they charge. But it's well worth it. When you're talking about a few $1,000s on a multi-million-dollar property, to make sure you know what you're getting your hands into. I mean, it's worth it.
Yeah. Yeah, so that is, if you guys have more questions on that, shoot us an email. For DD dollars, like, is there a certain percentage you put, for example, is the least amount you could put up? I hope that may, I'd say $100 a unit is pretty good for just your strictly due diligence costs, sometimes maybe a little bit more. Be ready for that. If you guys have more questions, email
I think
us
they
at
might be asking the deposit. DD due diligence dollars. I'm not sure if Tiffany's
least
asking
amount
for a
for,
deposit. What usually a
oh yeah,
deposit's 1%.
earnest money deposit, yeah, typically 1%. Yeah.
Okay.
We tackle deep value add properties, for example, properties that are 50% vacant,
Hmm.
high crime. yes to the first part of that deal. 50% vacant, absolutely. We've taken them over at 0% vacant. You know, if there's a story there, if it's on the path of progress, if it's high crime, that one's really hard to get behind because you never, you know, if it's a high crime area, you have risk of it never turning. You have risk of it being a high crime area for life, and there's only, you can't control a high crime area with renovating your property. Renovating your property, but it's still next to a jail, you're still gonna be in a high crime area no matter what. So depends on that
Yeah,
location.
I would say crime on the property is workable. We can work with that. But the crime around the area, you can only fix your property, right? So
Yeah, and if you guys want to get an inside look at our next deal that we're putting out that I'm talking about, we're doing due diligence. Also shoot us an email. Happy to go over that. As you guys see, we're hosting a bunch of events. These ones online for you guys. Our next educational webinar is going to be, we're going to be interviewing our SEC attorney. Stay tuned. We'll release that date here in the next couple of days. We'll actually be having a webinar about our new deal. Since you guys are on this webinar, you guys are actually the first ones to know. So shoot us an email there. If you want to come meet us in person, we're meeting up almost every single month in Dallas and Northwest Arkansas. Some really cool events this month. Dallas will have Brad Sumrock. He owns a coaching program, helps a lot, and he works with a lot of students and does apartment investing himself. He's going to be our featured speaker for the month of August. So that's August 22nd. August 20th here in Northwest Arkansas, we'll be having our broker panel similar to what we did last month in Dallas. Some experts in the area. ElevateCIG.com/events for events. We are still running our passive income fund webinar for some of you guys, or our passive income fund for you guys that are first time on this portal. We are really loving this fund. It's a good one. I'm investing in it personally. Our investors are getting, we haven't tipped a monthly cash flow distribution, don't plan on it. It's a nice debt position to be in on the investor fund. When is your Dallas meetup? I'll be in Dallas the last week of August from Maui. And well, Keone, awesome. We'd love to have you. ElevateCIG.com/events to register. And we'd love to have you too. The date on that is August 22nd. Thursday, August 22nd. So that will be the second to last week in that second to last week of August. Crazy, we're already in August here. August 22nd. Do we offer mentorship? So George actually did have a coaching program at one point. We're actually looking at revamping that in the coming sometime soon. More of an all-encompassing, probably get a little bit of everybody at Elevate. So stay tuned for that. We don't currently, right now we are focused on doing good deals, operating good deals, but we are working on bringing a mentorship coaching opportunity very soon. So George put that link there in the chat, georgeabrew.com. You guys can sign up there. You'll be the first to know once we do have that ready to go. Website has good resources there. You can sign up for investor portal, whether you're planning on investing or not. It's a good idea to look at deals, see how we're looking at deals. Maybe you can pick up something there. Maybe you can see what you might look at future deals there too. So what is the investor fund? And you guys, we are over. So you guys, we will be sending a recording for those of you guys have to jump, but I'm absolutely I'll continue to answer questions, but anybody that does have to jump, we'll be sending this recording. So the income fund is a debt. You could call it a debt fund, income fund, private credit fund. So it's a fund that we're investing into existing assets that's getting a fixed 14.5% return to our investors. That's net to our investors. We're not taking any fees on it. It's going to be about a 3 to 4 year hold. Could be 2. I would say 3 to 4 years. We're giving monthly cash flow distributions from it, and it's sitting in a preferred position. So we're looking at the equity stack. We're getting the bank note. At a $30 million deal, you're getting a bank note of $20 million. You might have a preferred equity of $2 million or $3 million, and then having equity of 7 to 8 million. That 2 to 3% is charging the deal 14.5%, but it's sitting above the common equity. So it's a really interesting fund. That is, you can also get access to that on elevatecig.com/invest. You'll go to our website. I'll just take everybody to the website real quick. So this is all our stuff. This is what we own currently. This is the events page that I talked about here. You guys are on this one. And here are some of the events. Sometimes we'll have events that George and I will be speaking at too. But here are 2 featured ones coming up. And then invest with us. You can go here. Or just go to the portal login. And this will create, you'll register to invest. This will create a portal. And this is actually whenever we get a new deal, when we have, the fund is a rolling fund. So we'll be investing in that, reinvesting in it continually. But this is also where you get first to know about a deal. So you sign this up. If you're accredited or not. Some of our investments are for accredited investors only. Some of them are for not. Oh, Mina, who's not here, popping up right there. I understand. Log in here. Yeah, and I tell you guys that Mina is missing tonight because he's volunteering at church. So love to see that. So here's my personal investor dashboard. Everything that I'm investing in Elevate. So it'll show you all your different investments. Let's see, invest. So if you go here, you'll see investment opportunities. This is the MFCI fund, real estate income fund, debt fund. So it's a debt, 2 to 4 years, 14.5 to 18% invest now. This is all that. And then when we get new deals, we usually will send out updates through here. This is also where you'll get your monthly updates for deals. So yeah, appreciate you guys. Good session tonight. We will be sending out the replay to all over 100 of you guys who signed up, and excited to be talking apartment investing with you guys.
Thank you all.